Hello, this is Agatha, and this lecture is on receivables and how we account for accounts receivable and how we account for the possible uncollection of accounts receivable. So the objectives of this lecture are to describe the common classifications of accounts receivable, describe the nature and accounting for uncollectible receivables, describe the direct write-off method of accounting for uncollectible receivables, the allowance method of uncollectible receivables, to compare the two methods of uncollectible accounts, describe the nature, characteristics, and accounting for notes receivable, describe the reporting of receivables on the balance sheet, and we're going to talk a little bit about some ratios. So the first objective is to describe the common classification of receivables. The term receivables includes all money and claims against other entities, including people, businesses, firms, and other organizations. So basically, you perform a service or provide a product and you don't get cash right up front, you get a receivable. And it is an asset on your books. Accounts receivable are normally expected to be collected within a relatively short period of time, such as 30 or 60 days. However, you'll find in larger organizations that accounts receivable actually can go beyond that. But the thought of a receivable is it's short term. Notes receivable are accounts that customers owe for which there's some kind of formal written agreement and credit's been issued, and they could be short-term notes or long-term notes. Other receivables expected to be collected within 1 year are current assets, and if they're expected to be collected beyond 1 year, they're investments, and they're reported under the caption investments, and that's kind of covered in another chapter, the long-term asset chapter. The second objective is to describe the nature of the accounting for uncollectible receivables, because the biggest thing about a receivable is since you don't get cash up front, you are expecting somebody to pay you back. And as we all know, especially in a bad economy, there are times where people or companies do not pay you back. And so from a GAAP standpoint and proper accounting, you have to make some assumptions that you won't receive 100% of the receivable. So companies sometimes will sell their receivables to other companies, and that transaction is called a factoring of receivables. So there are some companies who don't want to deal with collections, so after a certain period of time they'll just factor their receivables off for less than face value, and another company will buy it and then they'll try to recoup the money. There are actually two methods of accounting for receivables that appear to be uncollectible. There's the direct write-off method and the allowance method, and the bulk of this lecture is going to talk about these two methods. The direct write-off method records bad debt expense only when an account is judged to be worthless. So you basically sit around and you wait, and when you find out the account isn't collectible, you write it off. The allowance method records bad debt expense by estimating uncollectible accounts at the end of an accounting period. And I have to say, for the most part, most companies will use the allowance method because it gives you a matching of bad debt expense with your revenues instead of just waiting and having like a cyclical upswing within your income statement or your P&L, if you will, of accounts when they're deemed uncollectible. The third objective is to describe the direct write-off method. So we're going to deal with that one first. So let's go through an example. On May 10th, a $4,200 worth of accounts from D.L. Ross was determined to be uncollectible. So you're going under this method, you're going to debit bad debt expense, which is an expense and it goes on your income statement. You're going to credit the receivable. So you waited until you found out that it was actually bad debt, they weren't going to pay you, you took it off your AR, and you hit your bad debt expense. Then later you find out that the amount written off is actually collectible. So then what you have to do is you have to put the receivable back on your books, take the expense away, and then collect the receivable and take the receivable off. So you have to do two entries when you're using this method of collection, when an account that was deemed written off now is deemed collectible. So let's journalize some more transactions using the direct write-off method. So let's assume on July 9th you received $1,200 from Jay Burke and wrote the remainder off. The remainder owed $3,900 as uncollectible. Then on October 11th you reinstated him because you received the full payment. So as you can start to see, this is a very up and down way of accounting for accounts receivable. It's almost like a gut reaction. There's no planning. It just, when it happens, it happens. So here's your payment of the $1,200. You thought the $3,900 was uncollectible. There's his account being taken off the books of $1,500. Then he says, oh, I'm going to pay you, so you have to put the bad debt expense, put the receivable back on, take the bad debt expense away, and then take the cash against the receivable. Okay, that's the direct write-off method. Now let's look at the allowance method, which, as I mentioned earlier, is more consistent, and most companies, even smaller companies that have a good accounting staff, will use this method. Okay, so on December 31st, this company estimated that $40,000 of $1 million balance in their records will eventually be uncollectible. So you take your bad debt expense against something called an allowance for doubtful accounts. So you leave the receivables on your books. You're just saying you think $40,000 is going to be uncollectible. So you still hit your P&L, but you're taking it against a contra asset account called allowance for doubtful accounts. Okay, notice I mentioned this as a contra asset account, allowance for doubtful accounts. It has a credit balance. It sits on your assets section of your balance sheet as a negative against the receivable. Let's talk about what net realizable value is. That's the net amount that is expected to be collected. So here you assumed of your $1 million, $40,000 is uncollectible. That's called your NRV, your net realizable value. So on January 21, Parker's account totaling $6,000 is written off because it's deemed to be uncollectible. So when you actually do the write-off, and this is when you know it's uncollectible, you take it against the allowance, and then you take the AR off your books, which was different than the bad debt method, where you went in and out of bad debt expense and in and out of the receivable. Here, when you took the estimate, you debited bad debt expense and credited the allowance. So when you write the account off, you debit the allowance and then credit the receivable. So if you print these slides out and go through them again after you listen to the lecture, it'll make a lot of sense when you look at the two side by side. And I do have a slide coming up where you compare the two. So here's a visual for you for the allowance method. You have your adjusting entry. It fills the allowance for doubtful accounts, and then the allowance for doubtful account is emptied out. So it's kind of a cute little picture. Okay, let's do another example. During 2008, the company writes off $36,750 of uncollectible accounts, including the $6,000 that we just booked a minute ago. After posting all entries to the right to write off the uncollectible accounts to the allowance for doubtful accounts, you have a credit balance of $32,550. So remember, the original $40,000 less the $36,750 leaves you a credit of $32,550. So let's visualize that in a T account. There's your January 2001 balance. Then you have a bunch of accounts made up of just, notice there's just two sitting there, but the total is about $36,750. So your ending balance in your allowance account is a credit of $32,550, which is right here. Okay. If Extone Company had written off $44,100 in accounts receivable during the year, the allowance for doubtful accounts would have a debit balance. So let's look at that picture. Notice here, if they had actually written a say off this amount instead, they'd have a debit balance in their allowance for doubtful accounts. So notice it can happen. Okay, it can be a debit or a credit. It depends on how you're going through and doing your analysis. Let's talk about collecting a written off account under the allowance method. So now Nancy Smith's account of $5,000, which was written off on April 2nd, is later collected. So you need to make two entries, one to reinstate the account and a second to record the receipt. So you still need two entries, but this time you're going to put the receivable back on the book, run it back through the allowance, okay? Then you're going to take the cash and write off the receivable. You have to do two entries. You can't just run it through cash and the allowance. You have to put the receivable back on the books and then take payment, just like we did under the bad debt expense. Okay, let's do another example. Let's journalize these two entries under the allowance method, like we did a minute ago under the bad debt method. So we received $1,200 from Jay Burke, wrote the remainder off, then reinstated the account and received full payment. So this time we take the cash. Notice that we're taking through the allowance that estimated bad debt. Then here we put the receivable and we write it off through the allowance account. And so we put the receivable back on from the allowance account. Here we wrote it off. Here we put it back. Then we take payment against the receivable. So, oops, sorry about that. So when you print these slides out, and in a minute I'm going to put one side by side, you're going to see the difference. For the most part, the entries look the same, but notice it's the allowance on the allowance method and it's using bad debt on the direct write-off method. So if you use the allowance method, you have two ways you can estimate bad debt expense. Okay, under the allowance method, there are two ways you can do it. You can use a percentage of sales, which I call the income statement method, or you can use an analysis of receivables called the balance sheet method. Some companies, like healthcare, they will use a modification of the two, because if you have an intricate accounts receivable and it is a huge asset on your books, like a healthcare or a hospital, you want to make sure you're valuing your receivables properly because there's so much risk involved. So let's talk about the percentage of sales. So here's our example. You had 3 million sales for the period, and it's estimated that 1.5% will be uncollectible. So bad debt expenses debited for 45,000. That's the 3 million times 1.5%. And this approach disregards the balance in the allowance account before the adjustment. So that's why I call this the income statement method. You just book the amount and you don't care about what's in the account to begin with. So here's your adjusting entry. After the adjusting entry is posted, your allowance for doubtful accounts will have a balance of 48,250. I'm going to show you that in a minute. So you book your 45,000. There's your 3 million times your 1.5%. Then you come over to your T accounts and you see that you had a beginning balance of 40,000, and then you did your adjustments here and you had your 3250. Now you're doing your adjusting entry because you deem that 45,000 based on your net sales is uncollectible. So now you have an adjusted balance of 48,250 at the end of the period. And then your bad debt expense was the 45,000. Okay, so this is the income statement method. It calculates the adjustment and then you balance your allowance count out. So at the end of the year, accounts receivable has a balance of 800,000. The allowance for doubtful accounts has a credit balance of 7,500, and the net sales for the year total 33.5 million. Bad debt expense is estimated at 0.5% of net sales. So let's do these three different journal entries given this scenario up here. So the adjusting entry is going to be the 3.5 million times 0.5%. That's 17,500. My balances in my three accounts is my 800,000 in my AR, because remember, we don't touch AR unless we're writing something off. My allowance for doubtful accounts is the original 7,500 plus the 17,500, and my bad debt expense is the 17,500. So my net realizable value is 775, which is the 800,000 minus the 25,000. So go back and print these slides out and make sure you can do these journal entries on your own by looking at the examples. You can also estimate uncollectibles, as I mentioned, based on analysis of receivables, and this is the balance sheet method. So the longer an account receivable is outstanding, the less likely that it will be collected. So remember we mentioned earlier there's buckets of a receivable, 0 to current, which is basically 0 to 30 days, 30 to 60 days, 60 to 90 days, etc. So we call that the aging of receivables. And you're going to do a problem like this in your homework, but you have all your customers and you age out their balances. So you can see Ashby Company has $150 in the bucket of 31 to 60. BT Bar is way out here in the older time frames. Brock has a current not past due amount, etc. So here's the aging of my receivables at the bottom based on my aging buckets. So when I look at it this way, based on my historical past, and I know this as the accountant of this company, if you will, that of my not past due stuff, about 2% ends up being uncollectible. My 1 to 30 days, 5%, and so on. And basically what I say for my company here is that anything over 365 days, 80% isn't collectible. And in healthcare, what we find is if a person has a self-pay account, maybe they didn't have insurance, or they have insurance but they have a copay, we deem 100% of that uncollectible at that point when it gets that old. So it depends on your company, it depends on the type of business, how rigorous your collections are, but this estimate percent comes from your business and your historical information. So here's collection rates by number of months past due. Typically, like I mentioned, if things are new, they're more collectible. As time goes on, they're 24 months out. Lots of times you aren't going to collect anything. So you have to be able to prove this to your auditors and feel good about how you value your accounts receivable. So let's do it based on the analysis of receivables. So we estimated that $3,390 of the receivables will be uncollectible, and the allowance for uncollectible accounts currently has a balance of $510. The bad debt expense must be debited for $28.80. Now remember, I called this the balance sheet method. So let's look at the T accounts here. First, let's do our journal entries. So we have our bad debt expense of $28.80 against our allowance. So we have our uncollectible accounts of the $33.90 minus the $510. And here's our T accounts. So I had my balance sheet method finds the ending balance of the $33.90. I had $510, so the difference is my expense. So print these slides out and put them side by side so you can see why I'm calling this the balance sheet method. I'm finding the ending balance, as opposed to the other method with the net sales. We were finding the amount and not worrying about what was already in the account. And that's a key point between the two methods, and it helps you remember how to book the journal entries. If the unadjusted balance for allowance for uncollectible accounts has a debit balance of $300, the amount of the adjustment would have been $36.90. Okay, so let's look at that. If you had a debit balance and you're trying to get to the $33.90, then your credit's going to be bigger and your expense is going to be bigger. Because remember, under the analysis of aging AR, you're finding the ending balance. You need to figure out what you're booking in the middle to get that ending balance. Okay, so let's do this example under this method. You had your $800,000 of AR, your allowance had a credit of $7,500, and your net sales for the year were $3.5 million. Using the aging method, the balance for allowance for doubtful accounts is estimated at $30,000. Okay, so you went through your little buckets on your aging and you figured out you needed $30,000 in there. So once again, we're going to do the ABC. So my A is 22.5 because I want my ending balance to be $30,000. I have to subtract the $7,500 that's already in there. My accounts receivable is $800,000. My allowance is $30,000, and my bad debt is $22.5. And my net realizable value is the $800 minus the $30. So the key difference between the two methods is under the aging, you find the ending balance is found and you back into the expense. That's why it's called the balance sheet method. Okay, let's compare the methods side by side, and if you want to print this out, it's probably easier to see. So just make sure you can see that under the direct write-off, everything runs through the expense and the receivable. Under the allowance, it runs through the allowance and the receivable. And there's entries that you move along, and on the December 31st, when you actually use the percent of credit sales and estimate uncollectible expense, there's no entry under the direct write-off. That's only an allowance method entry. So print this slide out and make sure that you get the difference between the two methods and the types of accounts that you're using. The key difference is the use of the bad debt expense as opposed to using the allowance. So under the direct write-off method, the amount of bad debt expense is recorded when the actual accounts receivable are determined to be uncollectible. The allowance account is not used. The primary users are small companies with relatively few receivables. Under the allowance method, you're using either the percentage of sales or analysis of receivables, or some, like I mentioned, some companies use both. The allowance account is used, and the primary users are large companies or companies with intricate receivables. Okay, let's describe the nature of accounting for notes receivable. A note receivable or a promissory note is a written document containing a promise to pay a specific amount of money on demand or at a definite time to an individual or a business called a payee or the bearer or holder of the note. The one making the promise is called the maker. The date a note is to be paid is called the due date or the maturity date. So here's just a little picture of what one looks like. So let's go through how to do the date, because that's really where people get messed up. What's the due date of a 90-day note dated March 16th? So the total days in the note's 90. There's 31 days in March. Your issue date of the note is the 16th. So you had 15 days in March. That leaves you 75 left. You had 30 days in April. That leaves you 45 days left. You have 31 days in May. That leaves you 14 days left. So the June 14th is the due date. So print this out. Some people this is intuitive, other people they need to be able to walk through it. So you received a $6,012 30-day note dated November 21 in settlement of an account. So there's your note. There's your account. So basically you traded an account receivable for a note because the person couldn't pay you, and so now they're going to pay you over a longer period of time and pay you interest. On December 21, when the note matures, the firm receives the principal plus the interest. So you get the whole amount, the note comes off your books, and the difference is interest revenue. Okay, so that's the $6,000 times 12% for the 30 days that they had it outstanding. If they failed to pay the note on the due date, it's considered a dishonored note, and you still book it. So you have interest revenue. So you record the dishonored note plus the interest. So basically you're putting it back on the account receivable, the whole note plus the interest. And you ask yourself, why do you do this? Well, until you deem it to be uncollectible, just because they failed to pay on the note on the due date doesn't mean they're never going to pay you. So this is just, you know, probably what the original agreement said. Some companies will just keep the note receivable out there and keep accruing interest. Okay, a 90-day 12% note dated December 1st is received from Crawford to settle its account, which had a balance of $4,000. So you have your note, you take the receivable off your books. So now you want to record, assume the accounting period ends on December 31, an adjusting entry. Remember our adjusting entries. This is a new adjusting entry that you're going to do. You're going to record interest receivable and interest revenue for the 30 days that have gone by. Then when they actually pay you on March 1st, you're going to get your cash for the whole amount of principal and interest. The note comes off your books. You had interest receivable that you had previously booked, and then you have interest revenue for the rest of the days. Okay, so this is an example of you make this adjusting entry at the end of a period for any interest accrued. So let's do another example. Same day surgery center received a 120-day 6% note for $40,000 dated March 14th from a patient on an account, this is common in healthcare. So July, you determine that there's 120 days, and this is the split of the days. You're going to have your $40,000 plus your interest calculated as such, which is $40,800. So you have your 6% times 120 days out of 360 days. In accounting, we assume 360 days, 30 days across the year. That's just kind of the way the notes are done. And then when you collect it, you get your cash, you take your note off your books, and you have interest revenue. Let's look at how we report receivables on the balance sheet. Notice what I mentioned earlier. It sits, receivables come under cash. And here's your contra asset account called the allowance for doubtful accounts. It sits a negative against the account receivable, so you show your receivables at net realizable value, which is this right here. And then interest receivable. So here's all your different kinds of receivables. The detail of the accounts receivable sits in a AR subledger, and it's a separate journal, separate ledger, if you will, and has all your customer information, and it ties to your AR control account on your general ledger. And that's something that auditors will look at. They'll test your account receivable ledger and make sure that it balances against your GL and that the transactions flowing in and out tie back and forth. I'm going to run through this pretty quick. I don't heavily deal with the ratios in beginning accounting because you do cover them a lot in advanced accounting. But there are two different ratios that are important with receivables. There's the account receivable turnover, and that measures how frequently during the year your AR is being converted to cash. And this is important if your receivables are huge on your books and they make up a big amount of asset. It's a good test. It's your AR turn is your net sales divided by your average accounts receivable. So here's a calculation of how you would come up with your average receivables. It's your, each year divided by 2. So in the first year, you're going to take these 2 years and divide it by 2. And you're going to come up with 2337 and divide it into your net sales of that year, and that's going to be your turn, and it's 7.4 times. So each industry has standards of what's comparable, what a good turn is. Depends on the type of business that you're in. So here's the second year, calculating the same thing. So it went from 7.4 to 7.5. The next ratio we talk about is the number of days sales and receivables, and this assesses the efficiency in collecting your receivables and the management of your credit. So it's the average AR divided by your average daily sales. So using the same examples here, you're going to come up with your average AR and you're going to divide it by your average daily sales. and you're going to get 49.1 as your number of days sales in AR. So once again, depending on the kind of industry that you're in, that ratio will make sense. So that's a very high level of ratios within AR. I just want you to have heard it. If you're moving on in accounting, you're going to spend more time with the ratios and financial analysis. So in summary, go back and print your slides out. You need to understand the different classifications of receivables, that AR has to be valued and deemed. If there's uncollectible AR, you have to value it properly in your financial statements. You have choices of methods. The direct write-off, which is usually smaller companies with little AR, as opposed to the allowance methods. And under the allowance method, you could use the net sales or the aging. And then we talked about notes receivable. So if you have any questions, send me an email, and make sure that you understand these concepts before you work through your homework. Thanks.